Carbon trading. Understanding the basics. Carbon trading, also known as emissions trading, is a market-based approach used to control pollution by providing economic incentives for reducing emissions of pollutants. It's a key tool in the fight against climate change. The core idea is to put a price on carbon emissions. This system aims to lower overall pollution levels more efficiently than traditional regulatory methods. By creating a financial incentive, companies are encouraged to find innovative ways to reduce their carbon footprint. This ultimately benefits the environment. The system typically works by setting a cap on the total amount of greenhouse gases that can be emitted by a group of companies or industries. This cap is then divided into allowances or permits, each representing the right to emit a specific amount of carbon dioxide or other greenhouse gases. Companies that emit less than their allocated amount can sell their surplus allowances to companies that exceed their limits. This creates a market for carbon allowances. The price of these allowances fluctuates based on supply and demand. Companies exceeding their limits must either reduce their emissions or purchase additional allowances. This provides a financial incentive to reduce emissions. The overall cap ensures that total emissions stay within the set limit. There are two main types of carbon markets: cap and trade systems and baseline and credit systems. Cap and trade systems, as described earlier, set a limit on overall emissions. Baseline and credit systems, on the other hand, reward projects that reduce emissions below a predefined baseline. In a baseline and credit system, projects that reduce emissions, such as renewable energy projects or reforestation efforts, can earn carbon credits. These credits can then be sold to companies that need to offset their emissions. This incentivizes investment in green technologies and sustainable practices. Both types of carbon markets aim to reduce greenhouse gas emissions. The choice of which system to use depends on the specific context and goals. Different regions and countries may implement different types of carbon markets. Carbon trading offers several potential benefits. It can lead to a reduction in greenhouse gas emissions. It also encourages innovation in clean technologies. By putting a price on carbon, it incentivizes companies to find cost-effective ways to reduce their emissions. This can lead to the development and adoption of new technologies and processes. It also promotes investment in renewable energy and energy efficiency. Furthermore, carbon trading can generate revenue for governments and businesses. This revenue can be used to fund further climate action initiatives. It can also support the transition to a low-carbon economy. Despite its potential benefits, carbon trading also faces challenges and criticisms. One concern is the potential for market manipulation and fraud. Another is the risk of carbon leakage, where emissions are simply shifted to other regions. Carbon leakage occurs when companies move their operations to countries with less stringent environmental regulations. This can undermine the effectiveness of carbon trading. It's important to have international cooperation to address this issue. Some critics also argue that carbon trading allows polluters to continue emitting greenhouse gases as long as they pay for it. They advocate for more direct regulations and stricter emission standards. The effectiveness of carbon trading depends on the design and implementation of the system. Several carbon trading systems are in operation around the world. The European Union Emissions Trading System, EU ETS, is one of the largest. It covers a significant portion of the EU's greenhouse gas emissions. Other examples include the California Cap and Trade Program, and various regional initiatives in North America and Asia. These systems vary in their design and scope. They provide valuable lessons for the development of future carbon markets. The success of these systems depends on factors such as the stringency of the emission caps, the monitoring and enforcement mechanisms, and the level of participation. Continuous improvement and adaptation are essential. Carbon trading is likely to play an increasingly important role in global efforts to combat climate change. As countries and regions set more ambitious emission reduction targets, the demand for carbon allowances and credits is expected to grow. This will drive innovation and investment in clean technologies. The development of international carbon markets could further enhance the effectiveness of carbon trading. This would allow for the trading of carbon allowances and credits across borders. It would also create a more level playing field for businesses. However, the success of carbon trading will depend on addressing the challenges and criticisms mentioned earlier. This requires strong regulatory frameworks, effective monitoring and enforcement, and international cooperation. Carbon trading is a tool, and like any tool, its effectiveness depends on how it is used.